Hey Daniel, how you doing today?
Hey Megan, I'm doing great. How about yourself?
I'm doing pretty well, thank you. I am looking forward to chatting with you about a little bit about taxes, tax planning, and some changes that are headed our way, possibly if they
Fun
pass.
stuff.
Yeah, I know. It's getting towards the end of the year. Can you believe it?
It's like every year goes by a little bit faster, at least for me.
It really does. It's very interesting to think about how quickly the years gone by and how much we've all been through with this with everything going on in the world the past few years. So a lot to think about. But one of the things that really important is to talk about, prior to the end of a year, is to talk about any tax planning strategies we can implement with clients. So, um, the phrase I always use is, or question I always like to ask, and I know you're asking clients is, when do you work with your CPA? What time of the year, right?
Usually around tax time.
Around tax times. For some people, it's April 14th. Procrastination is the name of the game, but it's important. Your CPA is a wonderful person, and you need them to prepare your taxes. It doesn't necessarily mean that all of the tax planning that is necessary is being done. And while we're not tax preparers and we don't have our CPA licenses, full disclosure, I just need to say that, but it's really important to look at your portfolio, your investments, and your financial plan and say, am I being as tax efficient as possible? What does that mean in English? It means, am I giving away any money to taxes that I don't need to be unnecessarily? And again, we always want to follow the rules and regulations, but working within those regulations to make sure that we're implementing all of the appropriate strategies that we can is really important. So I know taxes are one thing that I've heard from everyone on the team that's speaking with our clients. It's a topic of conversation. So I'd like to talk today about tax implications, how we're seeing that, in our client portfolios, what you're hearing from clients, and also how we incorporate that private investment asset class that we talked about last week, and mitigate some of the tax risk. And I say tax risk because, just like I think you asked me or I asked you last week, I well, do you know what tax brackets are going to be in 10 years or 20?
Couldn't tell you.
Couldn't tell you, right? So, one of the hardest things I think for all of our wealth managers here to plan for is tax brackets, tax risk. If 100% of our clients' money is in an IRA, and they are a few years out from retirement, and we're trying to create and develop an income plan that's going to last them the 20 to 30 to 40 years that they plan to not be pulling a salary in from a job, and have an income plan. One of the most difficult items for us to plan for is, what are tax brackets going to be? I don't know. I wish, we always make we call it a joke, but our crystal ball is here and we shake it, it just doesn't work, it's broken, I don't know. But one of the things that we can do is plan the best that we possibly can with the knowledge that we have now, and make sure that we're mitigating tax risk as much as we can. So will you tell me a little bit about the conversations you've been having with the clients about what are some of the proposed tax changes coming up, what that looks like, and if they do go into effect, how it may affect them a little bit?
Sure. So some of the proposed tax changes that we've heard over the past year, right? So capital gains are on the docket. So the argument is wealthy people, they don't always pay the same tax rates, and it's pretty simple. They earn most of their money from gains and asset prices, right? So capital gains tax rates are, generally significantly lower than income tax rates. So that's something that there's been a lot of proposals floating around to change. I mean, some of the more extreme is even taxing capital gains at ordinary income rates for some of the highest earners. Now, that probably wouldn't make it through. I mean, I'd say that's more on the extreme end, but it could happen. I mean, a couple decades ago, the top rate was like 90%, something crazy like that. So it's not, at least based on history, it's not outside of the realm of possibility. Um,
Correct.
but then, another one that impacts quite a bit of our clients is something like step up in basis. Normally, if
Basis.
you have stocks in a brokerage account and they've gone up several 100% over a few decades, and if you pass them on to a beneficiary, then they get that step up in cost basis, which they're talking about potentially over $1 million. Then that cost basis benefit is no longer there. So that could be huge, especially with the boom in housing markets. The property we bought several years ago in this area for 400, 500,000 could very easily be pushing that $1 million threshold. So those are two of the main ones floating out around there. I would say in
Definitely.
terms of conversations with clients, just because the real estate market's been hot, we have several clients with rental properties where, they owned it in an LLC, they depreciated the property on their tax return over time, and then they sell it. And then it's like, oh my goodness, because you got to recapture that depreciation. So that's a big one that I've seen as well.
Definitely. Yeah. Thank you for sharing. I think, understanding, making sure, that everyone understands what you just said. That was a lovely way of describing it all. I think, if you don't mind, I'm just gonna give an example of cost basis, just so we make sure everyone, if anyone's tuning in, that didn't capture what that meant. So just an example you gave on the real estate, which was perfect. So you originally paid $400,000 for a house. It's up to over a million. Currently, there's the primary residence or primary home exclusion for $250,000 plus per person. So if you're married or partners, that's half a million. So essentially, in your example, if you paid 400 and you're a married couple, you have that $500,000 primary home exclusion right now. So the taxable amount would be, let's say if you're selling for a million even, it would be right at that $100,000 of capital gains that you would have to pay taxes on. So if you're in the 15% capital gain bracket, that's $15,000 that you're giving away in taxes at that point. And so if I heard you correctly, that might be changing. In addition to, I read something, and I don't know if you've heard an update on this, but in some proposed changes where a lot of our clients have a robust real estate portfolio, and they're planning on leaving it to the next generation because when they pass away, currently there's a step up in the cost basis of the home. So in your example, even though mom and dad had bought it for 400,000 and it's valued at a million, when they pass away, if Joe and Jane Smith, their kids, inherit that, they actually inherit currently the real estate at $1 million of cost basis, so they don't inherit the taxes. But that was something that's also in the proposed changes, that's a huge thing that we need to plan for if it does go into effect. And so a cost basis when it comes to investments, just to further highlight, is exactly like you said. If you bought a stock for and I'll just keep it simple with the numbers. If I bought a stock for $100 and I owned it for more than a year, because capital gains only apply when you've owned an asset for more than 12 months. So you bought that stock and you owned it for 2 years, and it grew in value from $100 up to $200. then your cost basis was 100, you have a capital gain of another $100. So the idea of that is now that capital gain, same things, that same thing, that $100 is now attributed a tax bill. And what you said, just to highlight it, is that one of the drastic proposals, which hopefully does not go into effect, but one of the drastic ideas that's out there, and this is not to scare anybody, but just this is reality, is that could be going to our ordinary income bracket. Well, a lot of our clients are, have an effective tax yield across the graduated tax scale of 25-30%. So now instead of talking about giving away $15 or $15,000, we're talking about giving away $25,000, $30,000. Is that what I heard you say?
Yeah.
Okay. So how do we fix this, Daniel? Because if I'm someone that might have this situation in my future, I'm a little worried right now. And I want to make sure that all of the assets that I've worked so hard to save and build, and our clients have worked so hard to save and build, and Daniel, that you've worked so hard to save and build, that they don't just all of the sudden, because of some legislation changes, all of the sudden now I'm giving away an extra 50% of what I thought, I had earned. How do we
Well,
change? How do we fix it?
it's a broader conversation, right? Private assets could, for the right type of deal, could certainly be appropriate in certain cases, right? So since we're along the topic of private investments, there are opportunities where if someone's realized a large capital gain, that they would be able to put that in this type of investment. They would be able to defer paying taxes on those capital gains up, I believe it's at the end of 2025. So they would be able to defer paying taxes on those capital gains. They would receive a step up in cost basis, right? So that burden would be a little less. And if they invest the proceeds in this particular fund and that fund does well, as long as they've held that fund over 10 years, that would not count as income against them.
Interesting.
So that's an example. It's
Mm-hmm.
called Qualified Opportunity Zone Fund. There was some legislation passed around that, which could be a very good tool for a client that realized a large capital gain, wants to defer payment on that, and then they also get the bonus if the Opportunity Zone Fund does well. They would be able to reap some gains that are non-taxable.
Wonderful. Thank you for sharing that. That's really important. And then also the other one that I know that we do with clients often, we help clients achieve, is the idea of a 1031 exchange. So that's currently, still on the table for clients if they own real estate, rental property, precisely, that has increased a lot in value, or they have a lot of depreciation, meaning that they've owned it for a long time and they've taken that depreciation over time on their tax return, that there can be options where they can use what's called a 1031 exchange. You have to use what's called a qualified intermediary, which is an attorney that we use before the property is sold. So it all has to be done, ahead of time. You can't wait until after a property is sold to do this, but you can use that 1031 exchange. It used to be called Starker Exchange. I know some people know that terminology. And you can actually put the gains, the money that you've sold your rental property through, into an investment. So those are called, there's several different kinds that we can use, but one's called a Delaware Statutory Trust. The other one is actually a mix of a Delaware Statutory Trust and what's called an upreit, and that uses what's called the 721 exchange. Again, we are not tax preparers, right? But tax planning is a huge part of the financial planning process. And so it's very important that you're having these conversations with your wealth manager, with Daniel, with Mike, with Chris, just really, really talking about anyone on our team having those conversations. Is there something I can be doing to mitigate any of my tax risk? So yeah, so the qualified opportunity zone is very interesting. I want to talk about that some more. I really like to unpack that in a future conversation. Is that okay if we maybe talk more about that next week, Daniel?
Yeah, absolutely.
Okay. And then, if any of the things that we've talked about today are either of interest or of worry, it's important that you reach out to one of your wealth managers here at the firm and get some more information. So the other thing that I really wanted to talk about, and maybe you can fill in some details for us, is just on the private investment space. So in that asset class, talking about taxes, there are some ways that we can actually what we call increase our tax alpha, right? So earlier when you were talking about having money in a brokerage account, that's not an IRA or a tradition or a Roth IRA or 401k. That's money that you've just saved from your savings account. The tax status is technically non-qualified, right? So brokerage, non-qualified, whatever you hear, cash, that makes you think of that money outside of those IRA retirement accounts. But how, if we have that money invested in, let's say, a mutual fund, and the mutual fund pays a dividend, when that dividend is paid, our clients experience a tax bill on that dividend. So even if they have, $100,000 sitting in their brokerage account and it's earning 4% in dividends, and those dividends are all being reinvested back into the account, they're getting a bill at the end of the year that they have to pay tax at your ordinary income bracket, not capital gains, okay, at your ordinary income bracket, whatever that may be, or effective tax yield, if you want to think of it that way. And you have to pay taxes on it. So a lot of times you're looking at your statement. I'm looking at my statement, my brokerage statement. Oh, wow, I earned, 4% this year in dividends. And then I earned another 2% in rate of return. So I earned 6% of this on this account, right? Because that's what it says on your statement. That's all wonderful. However, when you go to do your tax return, you have to pay taxes on part of that return. So you didn't actually earn 6%, right, Daniel?
That's right. And mutual funds, they oftentimes they distribute gains, right? They distribute gains. So there were people paying taxes on their mutual fund distributions in 2008. I mean, imagine.
Mm-hmm. Yeah. And that's painful because they're looking at their statement and they're seeing a 30, percent, 30, 40% loss, and yet they're still getting a tax bill. I mean, so how can we use some of these private investments to reduce our taxable, dividends on our money that's not an IRA or Roth IRA account, so that we what we call increase our tax alpha, or just decrease kind of the taxes that we're creating from our investments, so that we can keep more in our pocket. Because it's not about what you make, it's not about the rate of return, it's about what you get to keep, it's about what you get to spend. And that's a really important point that we are always speaking to clients about, right, Daniel?
Absolutely. I mean, taxes are a huge pain point, right?
Huge pain point.
And it's our job is to, within the legal structure, of course, is to try to legally minimize what we have to hand to the IRS.
Correct. Yeah, so some of our clients, we use these private investments. Sometimes we use what's called an interval fund. And I know that, for instance, last year with the market correction early in the year, a lot of our interval funds experienced a depressed value, and now they've come back. They're doing what they're supposed to be doing, but they kind of had this delayed reaction to the market volatility. That being said, when we're looking at a share value of a private investment or an interval fund, it's important to understand that that's not the only thing that we're looking at from a financial planning perspective to measure the viability and the what's the word the good intention of what the asset's doing for the client, what that investment's actually performing at is not just the value, right? Because if, for instance, I own personally in my non-qualified brokerage account, I own the Griffin Institutional Access Real Estate Fund, and it pays a 5.22% dividend. And out of that dividend, that fund, they manage that fund. So at least 50% of that dividend each year is not taxable at ordinary income, but instead, it would be taxable in the future at a capital gains rate. And so when I'm looking at my statement and I see that I've lost money, I'm really lucky because I know that there's some tax, benefits inside that fund. But for people that are super busy doing their job and being amazing at their career, glancing at their statement, it can kind of be frustrating to see that reduction in value because it doesn't say on your statement the tax benefit. It doesn't, there's nowhere that anyone can look and say, oh, well, I, made 5.22% on this in a dividend plus whatever the share value gained or lost, plus or minus. Oh, and by the way, half of that's not taxable as ordinary income. Whereas if it was in a mutual fund or a common stock, it would be. And so, explain to me a little bit more, if you don't mind, on some of the private investments. I just outlined an interval fund and how they can pass through that, those deductions and everything from the real estate inside the dividend, literally on the 1099. It 100% of the dividend's not in the taxable box. But explain to me a little bit, if you don't mind, Daniel, about the more even fully private side, like a real estate investment trust. How do those taxes work, and how can that help with these possible tax changes that we're looking at?
Well, for a lot of real estate deals, they're able to pass on what's called depreciation. So the value of the property, a non-cash charge where the value of the property goes down over time, they're able to pass that through to investors, and it defers some of the taxability of the income that they're providing.
Perfect. Yeah, I mean, I know back when I started working with a client several years ago now, started working with them, and they brought in, we like to look over your tax return, as part of our financial planning process. And I saw on their tax return that they had $40,000 in dividend income. And that's fine, if you're taking it, spending it, you need it, whatnot. But I asked them, I said, are you spending this money? And they said, no, I'm just reinvesting those dividends, back into my account. And I said, well, why are we paying ordinary income tax on income we're not using? Right? Why are we giving that extra money away? Um, there's a phrase that a lot of us use in the industry called dripping nickels. So the idea that there's money just kind of seeping away, and it can be in lots of different ways. It can be in your expenses. If you got signed up for some subscriptions or something that you're not actually using, making sure you're staying on top of those, even if it's $3.99 a month or $6.99 a month or whatever it is. If you're not using it, cancel it. Right? You're literally, money's falling out. There's holes in the funnel. And so if we can fix some of those holes, or at least put half a plug in one of the holes, and keep more money in your pocket, that's what we want to do, right?
Of course.
Yeah. So, um, I think that's a really good overview of the private investments, how they can help from a tax standpoint. And is there anything else that clients have brought up recently, in the past week that you wanted to talk about today? Anything of note?
I think we covered it pretty well.
Okay. Perfect. Well, I really appreciate your time again, and I'm looking forward to talking about the opportunity zones in more depth next time because I think it's a fantastic opportunity for some clients to make sure that they're shaving their gains off their portfolio and really taking advantage of further diversifying. It can be a great opportunity. So let's talk more about that if it's all right with you.
Very good. Sounds
Okay.
good.
Sounds great. Thanks, Daniel. Have a great rest of your day.
All right. Have a wonderful day. Bye bye.